Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. It was a tough day on Wall Street, and it was a tech wreck. Software names crushed again amid new product threats weigh on the sector. The big move we're watching is Bitcoin. Crypto getting slammed as Bitcoin broke below that key level of 75,000. Plus, Netflix co-CEO Ted Sarandos getting grilled on Capitol Hill over the streaming giant's deal to acquire Warner Brothers Discovery. We're getting a closer look at the antitrust concerns around that blockbuster deal. Well, Netflix's co-CEO faces lawmakers in the Senate to defend the company's multi-billion-dollar deal to acquire Warner Brothers Discovery.
So this is not a typical media merger where you end up with what's called the Noah's Ark problem, two of everything. We're buying a company that has assets that we do not, and we will keep investing in Warner Brothers. We will preserve one of the 5 major studios in Hollywood. We'll support theaters by releasing those movies with traditional 45-day windows, and we'll keep growing the American entertainment industry.
Here to discuss the legal road ahead, we got George Allen Hay, Cornell Law professor and former chief economist for the DOJ Antitrust Division. George, it is great to see you. So maybe we'll just start on that hearing, George. What did you learn? What was clarified, if anything, George?
Fine. The hearing was only a bit about antitrust. There was a lot more about about content. People complaining that Netflix is too left-wing or has a woke ideology. But a few of the senators were interested in the antitrust aspects. And the obvious concern is that Netflix is going to be bigger. They're already big in, depending on how you define the market, and they're going to get bigger. And that's certainly worth looking into.
So the key question there, George, is how do we define that market? Now, Netflix they're going to go broad, George. They say, sure, listen, we take on all comers. We compete with Disney, but hey, Ted's going to say, I got to compete with Instagram, got to compete with YouTube and TikTok, right? Do you agree with that, George? Is that the market?
I don't think they need to go that broad. I think all you need to do, if you include cable television in the market, and I think they can make a pretty good argument that people can watch Netflix or they can watch much of the same content on cable television, then their market shares drop to a level below what you'd normally see as a real problem. I think the issue is going to come down to, is streaming or on-demand streaming itself a market? If that's true, then their market shares are very high. But once you start to include other things, including just regular plain old cable television, their market shares are not nearly as high.
So here's some numbers from Bloomberg, George, just to put some context on this. They say if Netflix absorbed HBO, George, they say it would account for less than 11% of TV viewing. So you say, okay, that doesn't sound like too much. But Bloomberg says if you're looking at paid streaming specifically, okay, well then Netflix and HBO Max combine for about 30% of viewing and an even larger share of paid subscribers, George.
I think 30% is about the biggest number you're going to get, but that's basically right. If you limit the market to streaming, then their shares are significant and at a level where antitrust often worries about it. But if you include other things as options for viewers, like regular cable television, then the shares drop quite a lot.
And is the central antitrust concern, George, just to put it in simple layman's terms, is the concern if you let the deal go through, could it mean just fewer options and higher prices for George and Josh? Would that be the worry?
Well, there are two worries. One is, I'll call it the classic horizontal issues, and that is, and from perspective of both consumers and also providers. So you worry about a big firm able to charge more money, and that's a traditional concern of antitrust. One of the concerns that was raised in today's hearings was on the producer side. Will Netflix have control over what's paid to screenwriters and producers, much as in the Penguin merger blocked a few years ago? So yes, that's the horizontal side: control over the prices that consumers pay, control over the payments that are made to suppliers. There's also a vertical aspect, which is Netflix controls a lot of the content. How would they use that content? And there's a concern that they would use their control over content to basically push the theaters out of the market, not supply the traditional things that Warner supplies to theaters. The chairman of Netflix, I think, tried to put that to rest. He said he made a commitment that they will continue to treat theaters the way that the Warner Brothers have treated them to date. They're not going to put everything through Netflix, but that is a vertical concern.
So bottom line, George, would your bet be, yes, you think the deal will ultimately clear regulators?
This is a hard one to call because politics has become involved. If you took politics out of it, I think they have a pretty good chance of getting it clear. They certainly think so. They've, after all, offered in excess of $5 billion as a breakup fee if they can't get it through the antitrust authorities. And to do that, they're prepared to make certain concessions. For example, they can commit to offering movies through theaters. They can make a binding commitment as a kind of consent. So they can do a lot of things to try to make sure the deal goes through. So I think the answer is if politics were not involved, they'd have a pretty good chance of getting it through. Department of Justice can't block a merger simply because they don't like it. Ultimately, they've got to go to court. And if Netflix is prepared to go to court, then it's going to be up in front of a judge. And simply because somebody's big doesn't mean it's illegal. So I think they have a reasonable chance of getting it through. The odd thing about this one is that politics seems to be so heavily involved. You can't even tell for sure whether or not Netflix will remain the winning bidder. Paramount, I think, is continuing to make efforts on various fronts. They would still like to get this deal done for them. So, but if Netflix is the prevailing bidder, I think they have a good chance of getting it through.
On one last question there, George, on the politics, on the Trump administration, because I've seen some folks say, listen, it looks to them like the administration is more willing to let deals go through. In broad strokes, George, is that how you see it?
In very broad strokes, Republican administrations have been generally more merger-friendly than Democratic administrations. But this deal is not covered by that general philosophy. It's covered by a problem that the administration has with the media, a particular problem that they have with CNN, which ironically is not part of the deal. And in some sense, maybe the reason Trump would prefer that Paramount be the winner is that Paramount would then take over CNN, and Paramount could do something to CNN the administration wants. But under the Netflix deal, CNN is not out. It's not part of the deal. CNN would remain separate.
George, appreciate your time today. Thank you, sir.
My pleasure.
Stick around. Much more As for a Trend. Still to come, the takeaways of the trading day. Well, U.S. stocks declined on the second day of trading in February as the tech-heavy NASDAQ saw its sell-off gaining steam throughout the day. And Yahoo Finance's Jared Blikre joining us now with the trade day takeaways. Jared.
Got to talk about software looking a little sick, but this is nothing new. We've been tracking the dichotomy between semiconductors and software for a while. Neither one had a particularly good day, but software came out way worse. And let's just take a look. This is our heat map of software today. Only Cisco in the green. This is not comprehensive, but you sort by performance. You can see look, a lot of these names down 9-10%. So this is kind of a big deal here. And then if we take a look at the year to date, it gets a lot worse. We're seeing on the bottom row, Teladoc down 27, all the way to HubSpot down almost 40%. Only Cisco and Zoom in the green here. And then you take a look at semiconductors year to date. That is a vastly different story. Notably, NVIDIA and Broadcom are down, but the smaller ones are making up for it. And you can see that SanDisk almost up 200%, Western Digital up 70. And let's check out a comparison between two ETFs. We got IGV versus SOX. And guess which one is positive? That would be the chip stock, SOX, that's up 15% versus IGV down 20%. And if we show a 1 year, we can see where things kind of diverged. And here are those scary April lows we had post-Liberation Day last year. But it was really in October when chip stocks kind of, for the most part, went up and software was just flatlining. And then this year, well, actually starting in December and then accelerating into January, we just saw software kind of fall off. So a lot of this is being ascribed to AI and that whole story, but it's kind of telling when Microsoft cannot catch a bid, and Microsoft is down from $4 trillion to a $3 trillion company now.
All right, so software looking a little sick. What's not sick?
For that, we got to look at value, and let's try to value that. And I'll go back to my comparison screen here because I got something interesting. I'm going to show you the Russell 1000, which is large cap stocks, growth versus value. And let me just bring this down to our year to date first. There we go. And so value is up 5% this year. Growth is down 3%. What's the difference? Growth is your tech names, the companies that are just growing at a large rate. Value tends to be those stocks. Doesn't mean that they're necessarily depressed always in price, but a lot of times they are. And those are the stories where you're looking to unlock value. So GameStop was a classic example. 2019, 2020, Michael Burry went long, of course, a roaring kitty, all of that good stuff. But suffice to say that, so we're seeing a big divergence this year. And again, if I show a one-year chart, you can see, well, they're almost about the same from 1 year ago. But that's because growth got absolutely killed here in those post-Liberation Day lows, whereas value held up a little bit more. And I'm going to show you another way of looking at this. If we go to the large cap sectors, and we'll keep this on year to date, if I look at what is winning this year, energy, materials, staples, industrials, utilities, all of these except materials are potential value sectors. And why is materials in there? That's because it's up because of gold and silver. So suffice to say that the value stocks have really been leading this year.
So let's switch gears here, talk about Bitcoin.
Yes.
Because did I see Bitcoin drop below the Jared Blikre line in the sand? Is that what I saw?
It did.
Yeah.
Let's check out the latest price. I said if it goes below 70,000, probably crypto winter. But if it hits if it hits 70 and it bounces back and stays above 80, well, then we could have a different scenario. That could just be a washout of the week long. So here's Bitcoin down 14%. And here is that big sell-off that we saw today. Let me put the 3-year back on so we can see why I like 75. It was a 2024 highs, a 2025 lows, and there we go. Now we have dipped below it, and what I liked, I'm going to show you the 5-day price action here. What I liked yesterday is we hit a low, and you can't even see this because we need candlesticks, but we bounced up pretty sharply off of that. But what I don't like is we should have continued that. Instead, we just kind of leaked lower, and then we had another waterfall to the downside. So I'm not counting out the bull case here, but it's looking not the best. And if 75,000 ends up being a ceiling instead of a floor, and then we head below 70, well, that's a crypto winter scenario.
All right, thank you, buddy. Appreciate it. Stick around. Much more Ask for a Trend still to come. Snowflake is rolling out a new AI-powered coding agent. Yahoo Finance executive Brian Sozzi sat down with the CEO, who says their productivity gains could be dramatic.
We're announcing something called Cortex Code, which is a coding agent that is specialized to data. What that means is it understands Snowflake intimately, all its different capabilities, what you need to do with everything from how you ingest data to data pipelines to creating new applications and also creating AI agents. It brings the power of AI to automating many of these tasks, and it's been remarkable. We are seeing productivity gains of 5 to 10 times in getting jobs done. And customers like Whoop, which are early deployers of Cortex Code, that's the name of the product, absolutely love it. Obviously, there are many coding agents, but having one that understands data, that is specialized to Snowflake, understands all of its capabilities, and is natively integrated is a game changer. So much so that I, a CEO, can take a screenshot of an app, put it into Coco, that's what we call it internally, and have a Streamlit or a React app come out in a couple of minutes. It's a total game changer for us.
Sridhar, how does this change the business of coding?
Well, it enables people to get a lot more done faster. I think they can operate at a higher plane, data analyst, rather than write SQL. They create these things called semantic views, which you can think of as descriptions of data. That means that more business users can get access to this data using products like Snowflake Intelligence. Also debugging, figuring out where problems are just got a whole lot easier thanks to the insight that tools like Coco bring. It just makes everything go faster. And honestly, I think creates more opportunities for all of us.
A lot of focus, and if you and I were having this conversation a year ago, I would probably ask the same question, but more focus on how tech companies are monetizing AI. How does this new product, which sure makes a hell of a lot of sense to me, how do you sell a product like this?
First of all, it is a consumption product, meaning that when a Snowflake customer uses it, they just get charged consumption. In other words, there's not a huge upfront commitment for the product. And they can see the very clear return from how quickly their teams are able to get stuff done. I'll give you concrete examples. Our own support team adopted Coco to change their entire support pipeline. And what that meant in practice is that problems that would honestly take 5 hours to debug, Coco is able to debug them in a matter of 15 to 20 minutes using a set of specialized skills that they develop. I think it is that kind of productivity gain that are going to happen in every aspect of the data lifecycle. And we absolutely are going to help people do more, integrate with AWS, integrate with other systems like Airflow. We really want this to be the tool using which to get work done in the world of data.
I mean, this is amazing technology, and it's moving so fast. So what's the role of humans?
Humans exercise judgment. Humans have the context for how things should be done. You can identify what problem there is, but ultimately how you fix the problem is something that the human exercises judgment on. And I'm one of those people that always wants to make sure that this coding agent, even Coco, is doing the right thing. I think judgment will continue to be an important factor, reviewing the work, make sure that it's going well. Figuring out higher levels of abstraction is also going to be important so that you can develop these reusable components called skills that other people within your team can develop. I think it elevates the human role and takes away a lot of the drudgery that just makes getting work done so much more difficult.
The other component to the news that you're coming out with is you're inking a new partnership with OpenAI. What is it exactly, and what's the value to Snowflake?
We've always said, Brian, that there is no AI strategy without a data strategy. And this partnership represents a next logical step in an amazing AI company like OpenAI working closely with Snowflake. Yes, the $200 million is a commitment to spend on OpenAI models. Obviously, it's a big deal for us. That's a fairly substantial amount. But on the other hand, what this also means is that we are going to be collaborating closely to create AI products that deliver value. Customers like Canva, who are big customers of both OpenAI as well as Snowflake, are going to benefit from us working closely together. I think there are a lot of products that are going to create value in the enterprise, and the two companies working together, doing go-to-market together, is what is going to unlock that value.
You announced, I believe it was in December, a deal, $200 million deal with Anthropic. Why are working with Anthropic and an AI so important? And is it, I imagine you don't see one model winning out over time.
Well, these are the marquee model makers in the world. We continue to have a very healthy relationship with Anthropic, and they all have their specialties. And much more importantly, our customers want choice in the models that they use. I think of these as really important partnerships for us as a data platform. It's the combination of data platform plus the AI provider working together that's going to unlock enterprise value.
This has been a bit of a weird start to the year, Sridhar. Software stocks have really gotten hit, but companies like yours are still out here putting up good financial results. The outlooks have been strong. Where's the disconnect, you think?
Well, data platforms are also a little bit different from pure software stocks. And I think the data layer will continue to rise in importance. As you know, we bought an observability company called Observe. And the idea is to provide that kind of capability natively within the platform. Yes, these kinds of coding agents, things like Cortex Code, will make application development easier. But I think there will be durable value in big software providers as well. So I think the effect is a little bit overblown, but we feel very good about where we are because the data platform is the key to helping enterprises unlock value. And us working together with OpenAI and Anthropic feeds into that equation.
Time now for what to watch Wednesday, February 4th. We're going to start off on the earnings front. More big names on deck Wednesday, including Uber and Qualcomm, but all eyes on Alphabet's fourth quarter results. The Google parent company reporting after the markets close. Investors will be watching whether momentum around Gemini is starting to translate into real growth. Analysts saying Alphabet's core search business is holding up well, with ad sales insulated from any meaningful shift towards OpenAI's ChatGPT. There's also focus on whether new AI-driven tools across Google's apps can improve ad targeting and personalization, which could provide a tailwind for YouTube. Wednesday, also a big day for the pharma sector. Eli Lilly, AbbVie, and Novo Nordisk also reporting quarterly results. Eli Lilly's guidance in focus, with management suggesting that pricing is more predictable, but that volumes remain unknown. Analysts are also watching how quickly newer weight loss treatments ramp and what that means for margins as we move through 2026. And finally, a quick macro check with ADP employment report. Economists expecting private payrolls to rise by about 45,000 in January, up slightly from December, a data point that could shape expectations for the labor market and the Fed in the months ahead. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet.